Welcome to Commodities Corner. We have seen oil slipping a bit today, but it's near its highest in 3 months. In fact, we have seen oil moving back to levels posted last in November. It looks as though concerns about possible disruption to supply from the Middle East top of mind for investors. We're joined by Seigle, Global Oil Service Director at Rapidan Energy Group. It's great to see you. Clay, last time you were on, you said the market did seem a bit complacent. There wasn't much of a premium built into oil prices for possible disruption. Have investors changed their mind?
Thank you for having me. It's good to be with you. Well, we generally think that the market is still a bit complacent about that geopolitical risk to oil supply, but we're seeing some of that risk gradually start to creep back into the prices for crude oil and for the refined product with the most exposure to what's going on in these hotspots around the world, which is diesel, otherwise known as gas oil in Europe. So those diesel stocks in Northwest Europe are a little bit low, on the low end. And we now have the delays that are being felt in terms of arrivals of diesel cargoes into the European region from east of Suez, which is a part of the Red Sea geopolitical disruption story, now starting to combine with another hotspot that we've been watching for more than a year, which of course is Russia's war on Ukraine. During the past 4 to 6 weeks, 500,000 barrels a day of Russian refining capacity has been idled due to these long-range drone strikes by Ukraine, which of course is defending itself against Russian attack. And the refineries in Russia that are getting hit most recently have a lot of exposure to that international export market. So the European diesel market is especially under some upward pressure right now because of those supply disruptions.
Does that translate into a higher North American price, WTI? I know there's so many connecting parts in the oil market.
You know, the connection for WTI related to the geopolitical stuff is that more United States oil is getting pulled overseas, exports are higher, because some of those other grades are not getting to where they used to go when there were fewer disruptions. And so we're seeing that in Asian markets, and we're seeing it in European markets as well. United States oil, like WTI Midland, is an important part of the mix for those global refineries. But the main thing to watch for, again, on the refined product side is as those diesel prices creep higher in Europe, there's a stronger arbitrage or incentive for United States diesel to get pulled across the Atlantic into those European markets. That's going to elevate United States diesel prices as well.
What has the market's view changed? Well, apart from these Red Sea disruptions, Suez disruptions, and I know that's a big apart from, it's a huge, I mean, in some ways, well, give us your thoughts of the Suez is really the fulcrum of the global oil market in a way, isn't it? Because so much passes through there.
That's just it. You should look at the Red Sea and Suez as a shortcut that connect supply and demand between the eastern and western hemispheres. And over here, we primarily think about the east to west flows from places like the Mideast Gulf and India into the Atlantic Basin. But the Red Sea and Suez are also really important for westbound flows of Russian oil, both crude and refined products, to those eastern markets east of Suez. And we're starting to see more Russian cargoes taking that long way around the southern tip of Africa in order to avoid problems in the Red Sea. Some people thought at the beginning of this Houthi shootout with the tankers that the Russian guys would somehow be indemnified or have an easy pass and be off the hook from Houthi attacks. Whether it's faulty intelligence or whatever the underlying cause, Russian ships have come under fire as well in the Red Sea. So we see that no one is really immune to these pressures that are pushing freight prices higher, marine fuel prices higher, and they filter into the price of the underlying commodities.
What is your take on WTI then? Is it going to get above $80 after being stuck in this range really since November?
We're thinking that it's probably low to mid 70s for WTI on average during 2024, a bit higher for Brent. The storyline there is really about the global crude oil market, and we're expecting OPEC Plus to keep these supply cuts that they've had in force throughout this year and really through next year. And the reason why is because even though oil demand is still growing globally at a pretty good clip, about 1.5 million barrels per day this year, new supply from those non-OPEC countries that are not part of OPEC Plus are also creeping higher, about 1.1 million barrels per day this year. So if OPEC Plus were to relax the supply curtailment and let more oil flow into the market, I think we would see pretty large inventories start to accumulate around the world. They don't want to see that happen, and so they're going to keep those supply cuts in place. That winds up with WTI in the 70s during 2024.
That's interesting. So I think you said for 2024, your view at this stage, and I know there's a million factors, between 70 and 75?
That's generally the range that we should look out for WTI. And as I said, the international benchmark, Brent, we expect a bit higher. It could be as high as $80 average this year.
Clay, thank you very much indeed for joining us.